There we go. What I'll do, I just want to welcome everyone here. Siobhan Marlé from 91, thank you so much for your time. I've seen the presentation. It's absolutely awesome. Thank you so much for the hard work. And then Eugene, thank you for all your support from VIP. What I'll do is I'll start with Eugene, so that Eugene can just introduce Boutique Investment Partners. They are the guys that guide me and help me quite a lot. They assist me very, very well. So Eugene, I'm going to hand over to you, and then you could hand over to 91 then we can start with the presentation. Thank you, everyone.
Hercules, thank you very much for that introduction, and to the audience out there, thank you very much for joining. And for future viewers later on, it will be great if you can click on the link. We'll share it with you, and you can watch the recording afterwards. The NMS model portfolios are managed portfolios that we run on multiple platforms. A couple of advantages to the portfolios. It speaks to blending some of the top fund managers in South Africa, including 91, which are featured in most of the NMS or Nesher model portfolios. We run the model portfolios on multiple product platforms as well. So whether you have retirement assets or pension fund savings or discretionary assets, or even tax structures like endowments, you can find the NMS model portfolios. And like I mentioned before, one of our top represented fund managers in the portfolios is 91. For our audience out there, I'm sure everybody knows it by now, previously known as Investec Asset Management. Do you still mention that, Marley, when you speak to clients? I don't think you need to. But if you didn't know, that is Investec Asset Management is now 91 Asset Management, still the same great team of fund managers and worldwide known on the global circuit as well. So Hector, thank you very much. Happy to speak to your clients more about the model portfolios at a later stage. I don't want to steal the thunder of 91. Marlé Steenekamp and Siobhan Simpson from 91, thank you so much for joining us in the session today. You've done some great preparation in speaking to the audience. Crazy markets out there, a lot of questions. We read the papers. I always tell clients, don't read the newspapers, don't look at the news at night, because they only share the bad stories. They never share the good stories or all the truth. And I'm sure you are here to shed some light on what's happening in the world out there and some of your portfolios and your views. Thank you so much.
Eugene, thank you so much. Hercules, thank you as well. From our side at 91, I know a Friday afternoon at 3 o'clock is maybe a tough one, but I do believe that Siobhan Simpson, my colleague in Cape Town at head office, is going to end the week on a highlight and start the weekend on a better note with some of the news we've got. So just a quick one. I'm a sales manager at 91, based in Pretoria. And Siobhan Simpson is a sales manager in Cape Town. She also looks after most of our DFM clients. And we are very blessed with this opportunity to chat to the Nesher Investments end clients today. Chefs, over to you. Thanks for your time as well.
Awesome. Yeah, thanks everyone. And Friday afternoon, hopefully we'll go into the weekend with a little more excitement than how the week started this week. Eugene, I do still mess it up myself and land up calling one of our funds Investec Opportunity sometimes. So it still quite hasn't sunk in, even though it is 2.5 years later. So I think just as a reminder for everyone here, what has happened is previously we were part of the Zebra and a fantastic brand. It was really 3 parts: the private bank, the wealth division, and then asset management. And what's just kind of spun out is that asset management part. So that third little leg there has become 91. We listed on the 16th of March 2020, which was the worst day in the market at the start of COVID. But it wasn't a capital raise, so everything still went ahead. And it's 2.5 years later. We've got a new brand, lots of colors, and exciting times ahead. But like everyone has said, it's still the same people. It's still a global business. I mean, this slide is just a little bit of a marketing slide. You know, we are the largest asset manager in South Africa. But we don't say that to brag. We say it because also our roots are global. We've been able to access clients globally and bring also that experience back to South Africa for the benefit of our clients. We've got clients in 112 different countries, and we've actually now got more people sitting in our London office than sit in the whole of South Africa. So we've got over 500 people sitting in our London office now, which yeah, just shows the growth around the world. So kicking off, and we often get asked at the beginning of a year, I mean, it's a favored question in January, you know, what is going to happen this year? And another favorite question is, what's the Rand going to do? And if anyone tells you they know what the Rand's going to do, you know that they're a liar, because no one does. And what I think this slide shows us is just the risk and the how you should always be worried about people who forecast or things that, you know, this is definitely going to happen, and you put all your eggs in one basket behind that theme, and that theme doesn't play out. I mean, two things on this chart, what this slide shows is, you know, back in 1990, no one had actually ever heard of the internet. The internet actually only started in 1991. So, you know, like, it seems like everything is run on the internet now, but a short time ago there wasn't any internet. And I mean, who would have thought a few years before we had just before 2020, that the world's largest economy was run by a real estate developer in Donald Trump. I mean, you know, 5 years before that, no one would have thought that the Apprentice, essentially, that silly TV program, was now the leader of the US. So I think things change very quickly, and when you invest with a backward-looking lens, is very, very dangerous. And also when you look forward and you sort of say all eggs in one basket behind one theme, that's also very, very dangerous. And I think COVID was an incredibly challenging time, but also a good lesson, because no one could have predicted what would have happened at the beginning of COVID. I mean, I remember doing presentations in January 2020 and thinking, no, this is nothing to worry about. So you know, there's a lot that has happened in the last 2.5 years, and markets have been a roller coaster. I mean, some cities in the world are still going through these rolling lockdowns, and it's around what the world, how it learns to get by to some extent with these supply chain disruptions, with the changes. And you know what? Humans, economies, countries are very resilient. So there will always be sort of a short-term shock, which is, I think, what we've been feeling more recently, but long-term, things do sort themselves out, and we'll explore that a little bit now. So what did these sort of 2.5 years look like in the markets? And I've got on the left-hand side here the local market, equity market, and the right-hand side the global equity market. Someone said to me yesterday, what's an equity? The equity is just a share. It's the share, like the all share in South Africa. And what you saw is that initial pullback, and that drop down is the COVID shock. And then subsequent to that, you saw a very nice, very strong, very quick recovery. What has happened in the last sort of 6 months is actually we've wiped out a lot of those gains that we did have post the COVID recovery, and we're probably left questioning why this is the case sometimes. You know, yes, there's a war, and yes, you know, Putin invaded Ukraine, but there are a lot of other things that are happening, and a lot of things that are unwinding at the moment, which is causing the markets to wobble. And I had a great video, which hopefully you can get sent later, because it is all about inflation, and what we think inflation is going to, you know, the short-term movements in the markets are about inflation. And we're all feeling it at the moment. When you fill up your car, it's not costing you the same as what it did a year ago. When you put electricity in, when there is electricity here, it's not costing you the same. So when you go to Woolworths or Pick n Pay and you walk out with your bag of shopping, it is a lot more expensive, and that's a global problem. So what's happened? Why are we in this scenario? And really, we think about it as we've gone from an environment where there was this abundance. So what do I mean by that? After the global financial crisis, there was a huge amount of liquidity. What's liquidity, Siobhan? Well, like free money. I mean, even during COVID, the US government was giving checks to all their people. We've had the checks, equivalent of the checks, the grants in South Africa. But right from 2008, the governments, what they did was what we called quantitative easing. You might have heard that term. And it was literally just making sure that the stock market didn't fall down. So there was a lot of liquidity. They had very low interest rates. If you were a corporate, you could go and you could borrow money and go and try to do a project or not. In the US, you were paying next to nothing for interest. So why not go and try something? If it didn't work, it didn't work. And growth was very easy. So we saw a lot of stock market growth, and the markets went up, in a pretty much a straight line. When I talk to you about that liquidity, that stimulus, that QE, I just want to put that in context, because that's quite difficult to actually, these numbers are quite staggering. So this is what they call the Fed's balance sheet, okay? And you can see the beginning part, it wasn't growing. Then global financial crisis, which those of you, if you ever worked in the markets in the global financial crisis, it was a horrible time. That amount of stimulus is only a little bit on this graph. You'll see what happened in COVID. That is the COVID jump. And this is essentially the balance sheet of the reserve in the US. So they've expanded that balance sheet, and it's sitting on about $9 trillion. Now you can't even comprehend that in terms of the size of the assets. So there is a big problem. The amount of money that was put into the world as such was just very, very big. And now that is starting to reverse. And that is really the cause of why we're going from this free money, this great times, those lush gardens on the left-hand side of this chart, to this time where it's a lot harder. There's less liquidity, we've got rising interest rates and inflation, and growth is becoming scarce. Why do central banks have to increase interest rates now? Well, they're trying to curb or bring back inflation. All this free money has created this huge amount of inflation, together with obviously the supply chain disruptions. So if you look at a map, there was a huge amount of cargo ships. If you've ever tried to get a new cell phone or a laptop or a new car, you've battled over the last sort of 2 years. You've had to wait for it because of the supply chain disruptions. And obviously the war in Ukraine has affected inflation as well, because there is obviously a gas as well as a food issue when it comes to that side. I mean, Ukraine produces a huge amount of maize. So you've seen food inflation spike as well. So we've got almost, I don't want to say runaway inflation, but you've got higher than usual inflation. What central banks do, they try and bring down that inflation by increasing interest rates. And what then happens? So we feel it ourselves, right? If you've got a bond, you're paying more on your bond, which means that you've got less at the end of the month. And the same thing happens to corporates. So corporates that have debt, the interest rate goes up. Suddenly, they've got to pay higher interest rate payments. They've got less profits at the end of the year or the quarter, or whatever they're being sort of reporting on. And what does that mean? Well, this means the share price will have to go down if they're going to make less. So that's why you've seen markets come off a little bit more recently, because of these worries around inflation being higher. Interest rates are going to have to go up more. So then corporate profits are going to come down. And this changing environment also leads to a kind of a change in who the market leaders are. So the winning stocks in this era of abundance were these sexy stocks, for lack of a better word. Spotify, Tesla, all the FANG stocks. I mean, the number of times we got asked, do we hold the FANG stocks, the Facebooks, the Amazons? And it was incredible when markets went up. It's been quite a different story the last 6 months. And that really talks to the environment changing. The things that have done very well more recently have been the resource stocks, There's obviously a story behind that when it comes to Ukraine and Russia, but it's also in an environment where there is a lot of inflation. Commodity prices usually stay high, and therefore these kind of stocks do well. Your real assets tend to do well in an environment of high inflation. So let me show you this kind of chart a little bit of a different way. We're using two companies. You've got Zoom. I mean, we're on Zoom at the moment, so I feel a little bit rude talking about them in a negative way, but that abundance era, you see the green line going up, that's the market cap of Zoom, and at the change you see it sort of coming down. And the other company there is ExxonMobil, which is a oil and gas company as such, and you can see it doing not so well in the beginning part and then rallying more recently. So a period of two very different halves, and what a difference 6 months can make as well. And I'm sure that Eugene and Hercules are feeling the same when it comes to, and you guys, when you're looking at your statements. If you looked at your statement at the end of December last year, it actually looked not too bad. Equities were up, SA equities were up, and global equities were up nearly 30%. Sure, I think people would give their left hand at the moment to have these kind of returns. Fast forward just 8 months, and the 1-year returns look like those lighter green bars. SA equities have done 5%, offshore equities are -1%, cash, same, really just a little bit higher as rates go up, and bonds also not great. So you haven't got much to work with. So it's no wonder that we're feeling a little bit like this poor little girl feeling very despondent about what is out there and the investment opportunities. Now, like I said to you in the beginning, it's not very good to invest with a backward-looking lens. So you've got to look forward, and you have to look forward at what opportunities are out there. And while there is still a lot of caution that is warranted, there are some companies that are looking very exciting and some other investment opportunities. So what can you do? You've got a world that is full of inflation. We don't know when it's going to come down. I mean, the US had a print earlier this week of inflation that was higher than expected, and actually a part of it went up, core inflation went up. You've got rising interest rates, and there's the big R word, the recession risk. I often say when, my mom knows about the fact of, and she's a lot older, she says, if she knows about a recession, I think it's probably it's priced into the markets. But there is this recession risk. So what do you invest in when you've got this world which is a little bit crazy? And the kind of things we think are good opportunities out there. The first is high quality global businesses that have got pricing power and they can protect you against inflation. Are you going to stop buying toothpaste if it goes from 20 Rand to 22 Rand? Hopefully not. The same thing when it comes to deodorant, the same thing when it comes to shampoo, maybe coffee, a few other things like that. Those companies can weather the storm a lot better. Nestle is a great example. Nestle in the first quarter of this year put their prices up 5%. Should give a prize to someone who guesses what happened to their volumes. The volumes actually went up 2.4%. So that's an example of a company that's got fantastic pricing power. The second thing, and I don't want to be kicked off the Zoom call when I say the second thing, because you'll all go, why would you ever want this? But the second thing is SA government bonds. No, Siobhan, have you heard of load shedding? Have you seen what the government's doing? Well, actually, you're being paid for that. A government bond is giving you sort of 10 to 11%, which is a fantastic yield. And there is already a lot of risk priced in to that yield. So our yields are very juicy. We have the highest real yield. Now, real yield is your yield minus inflation in the world. So SA government bonds, a fantastic place to be. Yes, you're going to have a little bit of up and down, but hopefully the government doesn't go bankrupt. And you know what, if you own a house, you've got a much bigger problem if the government goes bankrupt. I'm only joking, I do own a house here. And the third thing, and you do need a little bit of this at the moment, is a little bit of cash. And you know what, you can't have too much because cash in the bank is going backwards relative to inflation. But why you want cash is that in times where the markets are volatile, they often go down, and you get really good companies and good opportunities that trade at a discount and trade much cheaper than they did 6 months ago. And you want to be able to buy those. So the cash is actually just the opportunity to buy stuff. So you want a little bit of that in your portfolio, so that when the time comes, you want to be buying some new businesses. And these are the types of businesses that we like. They're in your day-to-day life. 7 o'clock in the morning, maybe a bit earlier, hopefully, you wake up and you use your Johnson & Johnson shampoo. You have your morning coffee, you have an espresso, and that's a Nestle company. Then you log on to your work computer or just your computer, and you're using your Office 365. That's Microsoft. We also own that. Then you go do some online shopping, or this one says lunchtime shopping, and you go use your Visa card. Visa is a fantastic company. They, interestingly, I'll pause here and I'll tell you a story about them. When you use your card, say for example, it's a 100 Rand transaction, about 2 Rand of that goes to merchant, the kind of not the person that you're paying, and it goes to different people. Some the bank, some the card distributor, and a small portion, about 20 to 30 cents in that, goes to Visa. Now think of the amount of transactions that happen globally. That 20 to 30 cents of the transaction is just massive, massive quantity. And interestingly, you'll say to me, well, Siobhan, have you not heard of Apple Pay, or have you not got your card on your phone, or SnapScan? Those are all powered. You need a Visa card. You need to put your card on it. So interestingly, Visa still gets the money, even though it's not the physical card. Then you do, maybe your kids play video games at night, and they play the FIFA 20, and that's Electronic Arts, also a company we own. Something that's slightly funny here, you'll say, who is ASML? They actually make that's the little orange one there. In your smartphone, you've got a chip, and it's incredibly complicated and high tech. They're pretty much the only company in the world that make the machines that print those chips, and they have to be so accurate that it has to be the equivalent of a mirror running across the entire width of Germany, and it can't deviate by a millimeter. That's how accurate the printing of the chips has to be. So hugely, hugely technical company with almost a monopoly in the space. And then you put your eye cream on at night, and that's a Nivea product, and that's also a company that we own. So a lot of these companies are used in your day-to-day lives, and you're not going to give up hopefully, like I say, your toothpaste. One of the gentleman who runs this fund that I'm talking about here, Clyde Rousseau, he says to me, in these tough times when certain companies might go out of business, industries don't go out of business. And what you need to do, those companies that are the strongest in that industry are actually going to get stronger afterwards, because there will be some businesses that go out of business, and the strong ones will just sap up the weaker one's business. So I think it's quite a nice way to look at it. And look, I've mentioned some of these names. These are some of the names that are sitting on our bench, because we've got enough good ideas at the moment, but these ones are looking exciting. Some of them you'll recognize. I think the little lady there with the green round logo, you'll probably recognize that Starbucks. The one on the left there, L'Exotica, they make Ray-Ban sunglasses. So some different interesting ideas here. The little one on the top row, the fourth one from the left, it's called Mutai. It's a Chinese alcohol company. So there's a lot of different ideas in here from all over the world, and that I think are quite exciting. When we look beyond just equities, these are some of the return expectations from the different asset classes, and it might look a little bit complicated at the moment looking at this graph, but essentially what it's showing you is what is, of the assets that we own, what is the lowest expected return and the highest expected return we think we will get if we hold these assets for the next 5 years. So you can see our favorite asset class there on the left is global equities. We look between sort of 13% and about 18% over the next 5 years. And you can see there's quite a lot of assets that are going to deliver a decent amount of returns. You need to keep in mind that it's not going to be a straight line, and the wider the band, so the bigger the dispersion, the more volatile the asset. So you can see SA property, we think you can it's either going to be really good or it's going to be really bad. So we don't really like the asset class, not because we don't think maybe they'll get it right, but there's a lot of volatility in the asset class. It's got a very wide bar that's there. Okay, so I mentioned earlier that sometimes things change, environments change, and hopefully the market does at some point get a little bit of confidence that inflation is what we would say rolling over, that it's not going up anymore, that it's going to come down. And why would that give the market confidence? Because then it would mean that we've had enough interest rate hikes so that the central banks don't have to hike the whole time. So that's, they would stop hiking. And that's why markets will probably go down a little bit less once we reach that point. But some things in investing actually never change. And I'm going to give you 3 things which actually don't change, which you should always follow. And the first is that you should never follow fashion. Don't chase last year's winner. The second thing is to diversify your business, your portfolio and your business actually, because everything is stronger together. It's not just the Springboks. Bit of a bad one to make a joke on the Springboks this week, but anyway. And the third one is to stay invested, because spending time in the market is better than timing the market. And I'll give you a funny example of a fashionable thing, which our London portfolio manager who was visiting South Africa this week said to me. He said he knew that the markets were a worry, and I'm sorry if I offend anyone that has bought this, and he knew there was too much excess in the market when people started paying for art online, and they would pay millions and millions of dollars for a picture of a rock. And those are those NFTs that were, a crazy fashion, I would think, a little bit earlier this year. That's all gone quite quiet. So when we say don't follow fashion, sometimes what's in fashion is not always a good idea. And in my mind, people must only wear Crocs if they're a doctor. And having said that, my dad does have some, so I can't be too rude. But when it comes to investments, this is what I mean. And what we've done here is shown you every asset class and the performance in each calendar year. So you can see if you picked sort of, say, for example, 2021, the best performing asset class was SA property. It's in green there at 36.9%. But the following year, it's not a very good asset class, okay? And what we said was, okay, if I have a portfolio and at the 1st of January every year, I went and picked what was last year's winner, okay? So let's take, for example, at the beginning of 2018, I looked at 2017. It was SA equities that year, the Aussie there. So I switched my entire portfolio into what was last year's winner. And then the next year I did the same, and I picked the best performing from the year before. This would be your result. And we've called it the chaser portfolio. All the other gray lines on there are all the other asset classes. And then the green line on there is just a balance fund. And we've used our balance fund here. You can use any balance fund. You could use the Nesher a balance model portfolio, which I'll show you in a few slides time as well. The worst thing you can do is go and chase what last year's winner is. You can see how poor the performance is when it comes to chopping and changing. So don't go and look what last year's best asset class is and want all of that, or worse, what the best fund last year was. Oh, we see that a lot. This fund is the top of the pops on a 1 year. I need to go and switch all my money into this. Not a good strategy to follow. The second thing is that not one thing, and you've seen it with the asset classes, always outperforms. Luckily for me, because I don't really like him, Novak Djokovic doesn't always win, or sometimes he's just not allowed to play. A leopard doesn't always make a kill. I think they're about 1 in 5 they actually kill. Female leopards are a little bit more successful than male leopards, interestingly. And no one knows which car brand or which racing car driver or whatever to follow as well. And the All Blacks going through a bit of a soggy patch at the moment. But one thing we do know is that everything is stronger together. That's funds, that's an advisor and client relationship, it's teams, and that things are put together for a purpose. So when Eugene and Hercules sit together, they sit together and they say, what funds work well together, and let's put this one with this one with this one. And the reason is because of this. This looks like a mess to you, and it's a good thing that it looks like a mess. What I'm showing you here is it's the model, all the funds that are used in the NMS, have I got that right? Oh, it's difficult. Model portfolio, the balanced model portfolio. So it's the underlying funds. If the lines, over a 1-year period, if the lines are above, it means that the fund is outperforming the average. And if the lines are below, it means that they're underperforming the average. Okay, let's have a look. Manager 1 underperforms 29% of the time, outperforms manager 2, 83, manager 3, you can see the numbers there, right? We don't expect everyone to outperform 100% of the time. It's not possible really, okay? Especially over a 1-year period. Now what the guys do is they go and blend these funds together, and your resultant portfolio is that red line. Can you see how much less up and down that red line is? The benefits of diversification here are huge. And look at what percentage it outperforms. 91% of the time. It is the best when it comes to consistency of returns when you look at even all the underlyings. So putting things together makes the end goal or the end result much, much stronger. So I hope that helps from a portfolio construction perspective and understanding why you've got all this spaghetti mess. It's a good thing, the spaghetti mess. Now the third thing is around staying invested. You'll look at these drawdowns, and I mean, think of back to the global financial crisis. You woke up and you'd lost half your money. COVID, you'd lost a third. More recently, the max drawdown was around 23% on the S&P. But if you don't do anything, it's the best result, because over the long term, the markets do recover. They do go up. Companies make profits. And you can see if you had just stayed invested, even though they've gone down, nearly 50%, 55%, those drawdowns at the top, if you just did nothing, you would have made 357%. That's a return of 7% per annum in dollars, which is a fantastic return. So just by staying invested, I want to show that to you another way. We often find people saying, oh, I need, markets have fallen, I need to get out. And if you miss some of the good days in the market, so what we did here is we took 1 million rand and we invested it in the market, I think it's 20 years ago. It's 5,607 days. Okay, that's a lot. Now we said, what happens if you'd missed the best 10 days? Your investment, your end amount would have gone from 16 million, if you just left it in there, to just short of 9. So it's just more than half. If you'd missed the best 20 days, that's 20 out of 5,607. You're down at 5.4 million rand, and so on and so on. So you need to often what happens is the market collapses and it recovers very quickly. The other thing that this shows you is the benefit of compound returns. So you're earning a return on a return. And if you miss out of that middle one, you're not earning on that return. That's the compounding effect, which is massively powerful. I'm going to show it to you one more way before I finish here. And this is what often happens, and this is the global financial crisis back in 2008. The pink line, you can see how the pink line goes down. If at that point you said to your advisor and you said, I'm nervous, take me out of the market and just put me in cash. That's that gray line at the bottom. You can see how it underperforms. If you had said the green line, take me out of the market now, and in a year's time, I'll get back in. And you got back in a year's time. That's the green line. But the best thing you can do is actually just to stay the course and stay invested. So, you weather the storm through that downturn. So sometimes no one wants to be like this ostrich with your head in the sand. Sometimes it is the best idea just to actually not open your statement. We have to send statements quarterly, so you have to look at it when you get it. But it's best to be like this ostrich, and just actually don't do anything and move slowly and just almost ignore it, like the sloth here, because you know, that to stay invested and weather the ups and downs, it'll cause you much less stress as well in the long run, to be more sloth and ostrich-like. So those are the three things that I think, you know, you should always do, and that won't change as and when the markets change. Let Hercules worry about the markets. You just follow these three things to remember. Okay, and I'll hand back for some questions, and I'll maybe stop sharing, and we can all be bigger on the screen.
Thank you so much. That was an excellent presentation. Thank you for your time and the efforts you've put into this. I think it's great for everyone to just hear what is said and what's happening, and some good investment principles that came out of this presentation. And I think that's what's important. I think at the end of the day, if we can just summarize, I know some of my clients are really upset sometimes when I keep on saying, just stay the course, keep to the plan, stick to the plan. And really, I think that's the best advice. If I'm correct, I think it's Warren Buffett said, in times like these, just sit on your hands and do nothing. That's sometimes the best thing to do. Diversification, as you said, it's incredibly important, because that's what actually gets us through all these difficult times as well. And then obviously, I think the things to look for everyone here, I think the important thing to look at is to say, is it possible? What can we look at to see when will our investments really start growing very well again? And I think the important thing to look at is when inflation starts coming down, that will then help or assist inflation. Once inflation comes down, interest rates can start coming down again. And as you said, then the companies can make a bit more money, pay a bit more dividends, or whatever the case may be. People can spend a bit more, and then we can see a recovery happening as well. And I think the other problem, I think that if I can just tell the audience, I think also if China comes out of lockdown, the supply chains start normalizing, I think that will really assist a lot. A very stupid example, here in my office, we can't get parts for one of our printers. You just can't. So we just had to buy a new one. We just couldn't get the parts because there's such a backlog. So that just shows you where we are. But thank you so much for this presentation. What I just wanted to ask, there was Leon and Michelle, I think your hand was up. Do you want to ask a question maybe?
Hercules, I've got a couple of questions. Leon and Michelle, it looks like Siobhan didn't do a bad job. So thanks for that one. Hercules, I've got a couple of questions for Siobhan. I know sometimes the audience are maybe, they don't want to ask the questions. So I'll ask the difficult questions to Siobhan. And if there's even a question in Afrikaans, I can vertaal for Siobhan. And she understands a bit of Afrikaans because they need to up it. But maybe, Siobhan, my first question actually is, in the budget earlier this year, we know there's happened a lot. So some of you that don't know, Regulation 28, so a typical balanced fund, would normally invest only 30% offshore. That has changed to a 45% allowance, which is a 15% increase, and that is actually massive. Is that a good or a bad thing for us as clients? And also then, does it actually increase risk within our portfolios? I mean, if you invest in a balanced fund, Regulation 28, that's where you need to invest your pension fund money. So what's your views on that?
Yeah, so I think it definitely is. Anything that gives someone more flexibility is beneficial, but it also comes with a bigger responsibility. So like you say, it does increase risk, but if managed correctly, you know, increased flexibility to be able to go and buy other opportunities that we might not have here is fantastic. So we didn't have a very big, to give you an example, we didn't have a very big technology sector that we can invest in South Africa. We don't have a lot of pharmaceutical companies. We don't, there's certain companies that we can't, or themes that we can't access here. So to have that ability to go offshore a little bit more, find things that you can't access in South Africa, adds, like we say with the funds, it adds diversification for someone's portfolio. What you need to make sure of is that the managers who you choose to give that money are doing it correctly and have the skills to do it. So you want to be picking managers that have, that can say, okay, I want to analyze, these 50, 60, 100, 200, there's 4,500 stocks overseas, I think, or something crazy in the MSCI index. That you do enough research on what you are buying offshore, that you know those offshore companies and those offshore assets just as well as you know the South African assets. So yes, absolutely a fantastic thing to have the flexibility, but the responsibility now for Hercules and Eugene is to make sure that those managers are doing their job and their research on their whole portfolio and using that flexibility responsibly.
I agree with that, yes.
Cool. And maybe a question leading on the offshore investing, and so yes.
Maybe if Eugene wants to jump in, please feel free at any point, Eugene, as well.
Siobhan,
Marlé, if I can just say, I think what I liked a lot is Davie Rood, when I spoke to him, he's adamant that there's a lot more offshore opportunities than local. And he also said, you got to know, you're going to find those opportunities, and long term, they should really give, for the risk you take, you should be rewarded very well. So that's just a comment something I can add there.
Cool. So Chefs, my next question is actually the naughty question. You mentioned it, one of our favorite questions. What's our view on the rand? We've seen a lot of volatility this year. So when should I take my money out? Should I take it out?
That's me. So I think that one needs to remember that the rand is not just a South. We get very, very emotional about the rand, and we seem to think that load shedding is, impacts the rand, and obviously Zuma impacted the rand, and the rand's movement is not just our fault. It's only about 20% our fault usually, and most of the other stuff is the global environment. So if there is what we would call a risk-off mood, if the globe is worried, and economic growth is a worry or whatever, the rand is going to weaken against the dollar usually. We always look at it. You should always look at it relative to a whole lot of things, but most of us just look at dollar rand. So I think very important to remember that it's not just about us. It's about what the other side of that rand dollar is doing, right? The most recent weakness, the one that's taken us now to above 17, is actually about dollar strength and not about rand weakness. So if you look at us relative to the Aussie dollar, the pound, the euro, we're actually up. So on a trade weighted basis, so who our trading partners are, we're flat, but we're about 7, maybe a little bit more % weaker relative to the dollar. So this is very much dollar strength. And really, what's that about? Well, the US is pretty strong at the moment. They're the one that's, rates are going up. That's where the growth is. And yeah, it looks better than the rest of the other developed world options, the UK, the Europe. So I think just, keep it in perspective around, it's not just us, it's about the global story and what it means globally. The other thing that happens usually with these risk-off environments is that there's a flight to what we call safety. And what happens there is assets generally move back into the dollar. The dollar is seen as a safe asset, so that affects the rand. From a outlook perspective, one of the things that we look at is our terms of trade, so what we import and export, and that's fairly supportive still. Our commodity, our basket of, so what we import really is oil, and what we export is a lot of other commodities, and those commodities haven't fallen, the price of them hasn't fallen, so it's still quite supportive, the terms of trade for the rand. So we think this is the recent weakness is all about dollar strength.
Yes.
And hopefully for all of us and for any holidays that you've got planned, that that will reverse soon. Would I be taking, look, I'm not an advisor and I'm not licensed to give advice, and I'm concerned that, you know, this is obviously recorded. Would I be taking money outside the country at this point? You know, maybe not a massive lump sum, and maybe feed it out. But I mean, Hercules, you can probably give a better answer when it comes to from an advice perspective. But I think short term, it's probably, you know, it's about dollar strength, and hopefully that will sort of soften a little bit.
Thanks, Shifts. So, Hercules, I'm just looking at this chat. Dion, baie dankie vir jou vraag. Shifts, over to you on this one. What are we thinking on the Chinese property market? What's it going to do on Chinese growth? I know it's a tough one. There's a lot of asset managers that's saying China is actually uninvestable, where some of our offshore managers are saying that's where the growth is actually going to come from. They are the only country that have been decreasing interest rates. So just your view on that, Shifts.
Yeah, that is not an easy question. And it's a very, I think, polarizing question because people have very different views here. Some people are of the opinion that, like Marlé says, China is uninvestable because the government just decides what to do and then you're at their whim. But the other thing that you've got to look at is what we would call credit impulses and kind of the direction of travel of that. So Marlé mentioned already that they are stimulating. They're wanting to generate growth again. They're forcing the banks to lend in the Western world. What the central banks do, right? They use interest rates for that. So they have, they raise interest rates like they're doing at the moment to try and curb inflation, or they reduce it. What the Chinese do is they just tell the banks, go lend to this, and it's for this actual reason. Okay, and that was how the property area got into trouble. But the banks and obviously the government are very supportive at the moment. So if you look at the credit impulses graph, it's actually, while for the last sort of 2 years had been trending downwards, it's trended downwards and it's got a little uptick at the moment. So our global team actually has a big position in China and Asia. They have about, I'd say, 80% of their equities, of the equity portion in their balance fund in China and Asia. They are very constructive on that side. They think that it's the turn of the cycle from a policy perspective, and that while you were sort of fighting a headwind the last 2 years, that's turned, and for the next 18 months to 3 years, it's the start of a new cycle. Their economic cycles are much shorter than ours in the West, so they're around 18 months to 3 years. I don't know if that answers it enough. I'm happy to get more information on it, but that's about what I know. You've got the likes of some of our portfolio managers that they absolutely wouldn't touch it with a barge pole because it's all about, what they decide to do. But you know what, if you can make a short-term gain from some companies that are trading extremely cheaply because of the last 2 years, and you've seen that momentum change, maybe that's a good opportunity.
Thanks, Siobhan.
Thank you. Yeah.
Hercules, and this is actually a question to your style, but Siobhan, you can maybe also assist in answering this one because this is actually a naughty client question. But I know what we've seen recently is as the markets are so volatile at this moment. I mean, my dad is a dominee, and he's asked me, yes, Marlé, shouldn't I just be going in a fixed deposit or a guarantee? The bank is giving me, or some company is giving me a 10% guarantee for my money. Shouldn't I just go in there? Why should I have this market exposure? What's your views? Is it a good idea? Is it a bad idea? Help me to give a non-emotional response to my poor dad.
I'm not sure this response would go down well with the Germany, but anyway, you can use it everywhere else. But one of our guys internally likes to put it like this. He says, if someone were to offer you to go on a date, a blind date for 5 years, and they told you that only tell you at the end of the date whether you got lucky or not, would you go on the date? Because it's the same thing when investing now and locking your money up for 5 years. you don't know what is going to happen for the next 5 years. Yes, it seems attractive now. Maybe a blind date is a good idea now, and maybe 10% at the moment is a good idea. But where will we be in 2 years' time? Maybe the market crashes, I mean, forbid, another 20% or 30%, and then you want to go in and buy the hell out of it, for lack of a better word.
Yeah.
You know, and if you are locked in, you can't do that. So really, it's the opportunity cost and the optionality that you are foregoing over that period, where, you know what, you can actually go get a fixed income fund with a lowish duration that's got a yield of between 9 to 10%, and all unit trusts will give you your money back within 2 days. So I would rather go do that than lock my money in up, and maybe I'm getting another 50 basis points.
If I can just say there, if I can just say something, sorry, Eugene, where a lot of brokers destroy value for their clients, Siobhan, is where they actually, in times like these, take them out of the market, make use of that 8 or 10% simple interest, by the way, growth, and then try and put them back into the market again. And we all know you can't time that, and that destroys a lot of value. And I've seen that just doesn't work. I think sometimes that's more talk around the briefcase fire than actually making it work. But that destroys value if you're in and out like that. Don't know if you want to mention something, Eugene. Sorry, I interrupted you.
Yeah, Hercules and Marlé and Siobhan, if I can maybe just add to that, because that's a question we get very, very frequently from investors. If you look at banks, you know, Nedbank, Absa, Standard Bank, they're offering clients 5-year fixed deposits. It's very true. You know, you fix for 5 years and you're not sure if there was a better opportunity within that 5 years, and I totally agree with that. But if you just go look at the sums and you just make a simple calculation, the yields that they normally advertise and show you is what they call effective rates. So it's compounded rates. And that effective rate is roughly about 11.2%. So it sounds massively attractive. However, the nominal rate that you look at, so the non-compounded rate, you're looking at about 9.7%. If you deduct tax from that, because remember, this is all interest bearing. So other than your exemption, you're going to pay tax on this after the 5-year period. And if you've got an average rate of roughly about 40%, and I know the audience, it all obviously differs from person to person, you're looking at a net rate of about 5.8% after tax. You know, so all of a sudden what they offer that appears to be extremely attractive is maybe not that attractive. I'm sure there's a place in the world for these kind of savings, but you've got to take a lot of things into account when you look at these kind of rates, and especially things like tax. And I think, you know, that's where people like Hercules and one of the few intermediaries out there that's truly a tax expert can actually support clients on making this decision. Siobhan, what are the other points that you made as well? If you look at bonds at the moment, you know, extremely attractive yields, roughly, you know, anything between 10 and 11.5%. And if all goes well, if we do get into a scenario where inflation decreases, interest rates start to drop again, and it will eventually happen, we just don't know when exactly. And I think that's where economists start to look foolish, because they try to tell you when it's going to happen, but we all know eventually inflation will subside, interest rates will start to come down. Then you've got added to bonds the kind of stuff that you'll find in the 91 Diversified Income Fund and the NMS or the Nesher Income Portfolio, are these kind of bonds that, other than extremely attractive yields, can add a capital gain, which is not fully taxable. It's deemed capital. So your net after tax returns are probably going to look a hell of a lot better than what banks are dangling in front of clients' noses at the moment. But again, you know, it differs from client to client. That's what's very important, you know, to sit down with Hercules and look at your tax situation and what the best route is that you can possibly find.
Thank
Very
you.
good point.
Yeah, I just want to see if there's any other questions. Maybe if any of you don't want to ask a question now, you're really welcome to mail me, and I can send it on to Marlé and the team, and they can answer us as well. And we can take it from there. I think while I don't see any hands or any questions yet. I think We've gone for an hour. I've only booked everyone for an hour. Don't want to go too much over the time, but I want to thank everyone for this time. Yes.
So sorry. Dion had a question. Was that answered?
Yeah, it was.
Yes.
Yeah.
Just checking.
Thank you. So I think the other thing is I feel honored that my wife logged in to listen to us as well. Thank you, Sonia. Lekker om jy te hê. It was great, and I really enjoyed your presentation. Eugene, Marlé, and everyone's support. We're very thankful, and please believe us, we work very hard on the funds. We look at our strategies, we look at the diversification, and I think sometimes I'm Eugene's worst nightmare because I phone him every day. So, but that's, I'm just thankful for that support. And once again, thank you for everyone. We're going to make this link available as well, and we'll send it through because a lot of people couldn't log in today because of load shedding. But thank you so much. I really appreciate the time. I see there's one new message. Let me just see here. Oh, just saying thank you. Just one thing, maybe we have 2 minutes if you don't mind. That's a good question. What about cryptocurrency? If you don't mind, Siobhan.
I have to take my personal view. Well, I'll give you my personal view here. I think the difficulty with cryptos is how do you value them? I'm not disputing that at some point there might be a use for them, and there is a definite use for the blockchain.
Yes.
But how do you know that Bitcoin is better than Ethereum, that is better than this, that is better, and what the actual value should be? So I think that's the difficulty that I personally have with them. And I mean, I used this analogy with a doctor friend of mine. They were loving Bitcoin. I said, well, would you like to do an operation and then your client can pay you in Bitcoin? And they said, no ways. I said, well, why not? So he said, okay, I get it. You're not sure on how much it's, because it's still volatile. It's not yet a currency. I think that the headwinds that it faces to some extent are that to become a currency, is the government ever going to allow you to pay your taxes in Bitcoin? I don't think so. It's not in their best interest. But so becoming a global currency or a currency is tricky. I think it gets interesting when you have, like, China has just started its own crypto. I think that's when it gets a little bit more interesting. But me personally, I'm not disputing that there is some value in it. I just don't think it's, you know, something that can go from 65,000 to 20,000 to maybe it can go to 5,000, and that's actually the value. You don't know yet. I don't think. I don't know. Maybe someone else has got a better view. I'm a little bit, maybe I just don't understand it enough. But for me, that's my personal view.
If I may just say there, maybe I'm still old school, but I'd like to know there's a share certificate, number one. Number two, I do like the blockchain technology. I think it's some of the best technology in the world. So that's incredible technology if you look at that. The third thing that concerned me a lot about, and that's why we haven't gone into crypto, is I looked at Google. I saw a report. If a lot of people in the world Google crypto, it goes up. If Google goes down, it goes down. The price goes down. And that for me was showing one thing, that it's a really emotional buy. So a lot of it's emotional. And for me personally, I'm not saying it's a bad thing, but what I'm saying is I am still not, I'm maybe not at that point where I feel the risk is just too high in that. And if I can just give one example, I've got a client that got into Bitcoin through a friend, actually a family friend, and actually was at a braai place. And he's in a question of about 2 months, he lost over R1 million. So how they done it, I don't know, because it's not I don't even look into it. But I think that is something you got to look at. And yeah, I think just be careful when you do make use of crypto.
I think if it's for a small portion of your portfolio, then maybe it's you know, you can gamble with a little bit of, I say gamble investments with a you know, like I don't know what percentage, but it mustn't be your main retirement money.
No, that must be extra, yes.
Yeah. Siobhan and Atlas, if I can maybe just add very quickly to cryptos, and I agree with, all the comments that you made, blockchain being great technology and it's being employed in a lot of other different lines as well. Here's the big thing about cryptos. It's not regulated. So, in simple terms, you've got to buy and sell these cryptos through a platform like Luno or Zappo or whatever platform you use. And if your account, first of all, gets hacked, there's nobody you can go to cry out. And there are a gazillion examples of clients' accounts getting hacked and their cryptos disappear. There's no ombud, there's no FSCA, there's no regulator. A client's got absolutely no foot to stand on to try and find out what happened to that. And if you make a mistake with transferring cryptos from one platform to another, again, there's nobody out there. You can't drive to a bank or to an institution or to a company to try and find out what happened to your cryptos. So if you're really not an absolute expert in cryptos and fully understanding how that universe works, I think it's an extremely, extremely dangerous place to try and look at. Another point that Siobhan made, this very last point I make, is how to determine the value in that, and to take the exact opposite of that. And if you look at some of the equity stocks, the counterparts that they made mention of, companies that are held within the 91 portfolios, it's not about short-term market movement based on geopolitics or sentiment in the market. It's the principles of if you buy into a security or company where you know that company is going to be worth more tomorrow than what it is today, you are going to make money. It's a given. In short term, you've got price fluctuations, but over time, the market will realize that that company is actually worth a hell of a lot more than what short-term sentiment drove the price to be, and you've got price recovery. And you make very good money through managers like 91 investing in solid companies where they still grow their earnings, where they're still worth more tomorrow than what they were yesterday. And that's how you invest money, and that's how you secure your retirement in your future.
Thank you, Eugene. Well said. Thank you very much. Any other questions maybe before we go and have our weekend? Has everyone got one or two or any other questions? As I see, you can also mail us a question. Dion, thank you for your question. Charmaine for yours. I appreciate that. I think that's all. We've run a bit over an hour. I do apologize, but I think it was very interesting. I really want to thank everyone for being here. Thank you for presenting. 91's team is excellent. Thank you so much. That's why we also use you in our funds. Eugene, your support's extremely valued. I really appreciate it as well. And there's some of my team members on as well. Thank you very much for being here. And if anyone needs anything, you know where we are. You're welcome to mail us, WhatsApp us, or call us. We will assist where we can. I wish everyone a wonderful weekend. Thank you.